This video is all about the diagonal spread. The diagonal spread is my favorite trade because it offers just such a consistent revenue stream for me of cash and premium coming in to my account. It often doesn't matter if the market goes up or down during the time I am running a diagonal spread, which is often years on end. This will make me money consistently. So I'm here to share it. And I hope you all love this video because when I discovered this, I thought it was literally the best thing in the world, okay? So let's go through things that most traders struggle with. They usually struggle with unpredictable gains and losses, so there's no consistency in their account, even though that's something they would love to have. They have inconsistent income, and they have trades that require consistent monitoring. That they have to look at these all the time. The beautiful thing about a diagonal spread is you don't really have to look at it very often, maybe just every couple weeks, all right? That all changes with diagonal spreads. So we can generate cash flow every few weeks. There's low risk with long-term upside, and it really does work in any market condition, all right? So what we have coming up in this video is, one, we're gonna understand what the diagonal spread is. Two, we're going to set up the trade. I'm going to give you some examples. Three, I'm going to show you how you manage the trade once you set it up. And the fourth thing we're going to go over is when to exit and lock in profits. Because while we can run this for an extended period of time, like years and years, sometimes it makes sense to leave earlier because the profits are better leaving earlier. All right? Okay, so let's understand the diagonal spread. What even is it and why even use it? So you really need to think of this, the best analogy I can ever come up with is you need to think of it like owning a rental property, okay? So the long-term call that you're gonna buy is like a house, and you hold on to it, you have the house to collect rent and get appreciation, okay? The short-term call that you're selling is your tenant, and it's the rent that you're collecting from renting that house out. Okay, so really the beauty of this situation is that you're buying a house, which is your leaps call, and then you are selling calls against your leaps, which are your rent payments on owning the leaps. It's so brilliant. Okay, so why even use it? One, there's more profit potential than a covered call. Okay, so if you know how to do a covered calls are capital intensive because you have to buy 100 shares of that stock to begin with in order to sell a covered call. Well, the diagonal spread allows you to use less capital to have the same right to sell calls. It's amazing. There's more flexibility than the vertical spread. So the vertical spread locks in profits or losses with a fixed expiration window, and diagonal spreads allow for continuous income generation because a long call can last months or even years. And here I'm really talking about years. And number three, there's more income than a long call alone. So if you were just to buy a leaps alone, you only profit if the stock rises. A diagonal spread generates cash flow in a sideways market or a down market or an up market because you can sell calls against it. So why even use it? The power of the strategy is that it allows you to profit from time decay, which in options is a Greek that we call theta, while still benefiting from the long-term price movement. That's why it's my to-go strategy for consistent cash flow. So what does a diagonal spread achieve? It achieves cash flow generation. So when you sell short-term calls, it generates consistent premium income coming into your account, which you can use to do so many things with, right? The next thing is that it can provide capital appreciation. So holding a long-term calls allows for large potential profits if the stock value of the underlying asset goes up, okay? And then the third thing that it really offers is risk control. So the short-term calls that you're selling offset the cost of the long-term call, which reduce your overall risk of having your money in the market to begin with. So there's just no downside to this trade, really. I just really, really love it, assuming you can pick the right leaps to buy. So now we're just going to talk about setting up the trade. So what we're going to talk about is picking the right stocks, buying the long-term call, which is the leaps contract that we're going to buy, and then selling the short-term call. It's all pretty simple. It's a complex idea, but when you break it down in the little bits, it's a lot more simple to understand. So we're going to get into something I go on about quite often, and I never will stop. I'm going to sound like a broken record, and you're going to hear this in your sleep at night, is that we have to pick the right stocks. So my non-negotiables for picking a stock that I want to run this on, or any options trade, is that number one, the stock has to be in a consistent rising pattern for 5-year, 1-year, and 3-month charts. They all have to be in an uptrend. That's green going up, okay? Like if one of those is off, I'm not doing that. I'm not running this trade or any trade on them. Number two, there has to be consistent long-term revenue growth and profits in the last 4 years. So if there's 1 year that's down, nope, I'm not doing it. All got to be going up. Number three, the stock has to have 70% institutional ownership. That is like an insurance policy that this trade is going to go well through time. It's a nice little thing that happens. And then high liquidity, okay? So you don't really have to worry about high liquidity or look it up, if you're trading a monopoly or an industry dominator, because they're going to have high liquidity naturally because they're frequently traded stocks. But some of these lesser known names, newer stocks, like I'm trading this stock right now called ASTS. It has lower liquidity. So that can be a little bit of a problem when you're trying to sell or roll an option. Okay, so just be cognizant of that before you go into this as well. And number five is just that highly volatile stocks are not a good fit for this trade. I've tried it. It's been very annoying. I would suggest not doing it. Okay. All right. So buying the long-term call. So a LEAP is a long-term equity anticipation security, right? And it's a call option with an expiration date of 1 year or more out into the future, okay? And so like a lot of people just buy a LEAP and they're like, hey, I bought a LEAP because it's a year, and they think that that's the end of it. Well, there are so many more options that you can buy than just like a year-long contract. And you just try to be creative here. You should look around. You should shop around. Don't just go for 365 days. The options chain has a whole lot more to offer than that. So instead of buying 100 shares, you control the similar exposure of owning shares or any percent of the exposure you'd like at a fraction of a cost. That's what a LEAP is. That's like the definition of what it does. But if the stock price rises, the LEAP gains value in most instances. There is like a caveat that at the end of owning your LEAPs, if the stock isn't in, it's a long story. But for most of the time, while you're going to own that LEAPs contract, if the stock is rising, you're going to be increasing your profits. There are some things that I teach on my course that can help you be better at selecting this, because every once in a while you can choose a bad LEAPs, and it's well worth getting mentorship to kind of figure out those things to look out for. There are too many to mention here, but that is why I teach a course, all right? So, but in addition to that, how you choose the best LEAP for a diagonal spread is obviously the expiration date has to be about 12 months out, or you're not even going to have a LEAPs, right, to begin with. People try to run diagonal spreads on 2 to 3 month periods in time, and I don't see the point myself, and I don't think it's a winning trade very often. I think it's more difficult to manage, and I don't like it. I've tried it. So that would be my tips for success here. And number two, pick a strike price that's out of the money. And this works well unless the market is extremely bullish. And number three, make sure the LEAP has high open interest and liquidity to make sure that easy trades adjustments are made later. Again, if we are trading a trade that is a monopoly or an industry dominator, a stock with those types of characteristics, you're going to be fine. All right. And then now that we have our long-term call, our LEAPs, we need to start collecting income by selling short-term calls against it. One call at a time. Only one. But I say calls because we're going to sell a call and then we're going to wait for it to expire, or we're going to roll it out into another call. So there's going to be multiple calls we're going to sell. Okay? So the purpose of the short-term call is to generate consistent premium income every 2 to 4 weeks. It also offsets the cost of the LEAP, which reduces risk. It reduces the risk that we put into the market of buying the LEAPs in the first place. And we get to take advantage of time decay or theta, which works in our favor. So how we select the best short-term call for maximum income is that we choose an expiration date that's 2 to 5 weeks out. I prefer 3 weeks for my calls that I sell. I just feel like that is a great expiration date that allows me a lot of flexibility. There are some people who love to sell weeklies. I think that's a lot of work. It's really something that you should experiment with. There's also data that suggests that a 45-day call is the most profitable, but I really do like the 3 weeks. So that's just me. And number 2, figure out how much income you can get for the calls sold against the leaps before you buy the leaps. This is essential. Like, you should be doing math ahead of buying your leaps to sell calls against it. This sort of seems obvious once you do it the first time, but if you never have, you can actually predict how much money you're going to make over the course of owning the leaps and see if it'll be a profitable venture for you or not. Okay. So this is like my best tip ever, is to try to work these things out in advance and not just like buy a leaps on Apple because you're like, yeah, then I'll sell calls against it and I'll make money. You could just do the math in advance and see how much money it is going to make within a range. All right. Okay. So let's do an example here. So here's an example trade setup. If you sell the Google 177.50 call expiring March 28th, 2025, for an approximate 2-week call, the premium collected is $130 per contract. And again, we can only sell one. So selling the call against the leaps helps you generate cash flow every 2 weeks by holding a long-term position. This is how you create predictable or recurring income. Okay? So for risk management here and position sizing, diagonal spreads have 2 moving parts, which means unmanaged risk can lead to assignment or excessive losses. And when I say excessive, it's not like you're going to make excessive losses here, I don't think. But I don't like making any losses on these because there's just no reason to. Like, if you manage it right, you can get by with this with always making money, okay? If the short-term call moves deep in the money, you could be forced to buy 100 shares or close the trade at a loss. This is something you must avoid to be successful or have happen to you very rarely, okay? So this is the big risk, okay? Like, if the short call blows past the call strike price that you sold, you're going to be at a loss. So you don't want that to happen. So you need to be able to manage that trade, and we're going to get in how to do that in just a minute. How do we identify when to roll? So the number one thing is that if the stock price nears the short call's strike price, you're going to want to roll, okay? You don't want to let the stock price exceed that strike price, or you just get into a situation where you're like underwater and it's really difficult to roll once you're underwater. So if we sold like this 177 strike call on Google, for example, and Google is trading at 165, we sort of built like a significant pad there. What is that, like $12? That's a nice little pad. But if Google kind of like pops, we're going to want to know about that in advance. So what I do is I set a stock alarm for the strike price of 176, stock price of 176, and I get a little like ping on my phone that has happened. And as soon as that happens on my phone, I just go in and I roll out then. Okay, so this is one of like my best tips, is that I don't like to sit in front of a computer all day. I don't want to trade all day. So I use a stock alarm to tell me what to do. And this makes it just so much easier, and I don't miss those moments, because missing those moments can cost us money. The second reason I would want to roll is because the theta decay is almost complete. So that's what we're relying on. How we make money as options sellers and options traders is to take advantage of theta decay. That's one of the main tricks in our playbook. So most of the premium is usually collected like up front in the contract if the stock price like kind of stays the same. So if you sell like a 3-week call, 4 to 5 days before the expiration, if the stock has sort of stayed in the same range, there's not that much meat on the bone left to pay back in that contract. And you could probably roll it out to the same strike price later in time and collect a really nice premium again at that point in time. And if that's the case, I would go ahead and do it. And then my third thing here on just knowing when theta decay is almost complete is if there's only like $10 to $12 or something, $20 left in a $300 premium, of course I'm going to roll out. Like, there's no reason why not to. I want to go get another $200 and $300 right now, don't you? The other thing, and this is more difficult to predict, is And you have to be really good at reading your news and having some experience in the market here, which is why I always suggest people should read Yahoo Finance for like 10 minutes a day, is if you can tell that the market suggests a strong uptrend, or if we are in a pattern of SPY going up like this all the time and we're in a downward day, and then we're probably going to go up again soon. So if the stock looks like it's breaking out or the market's breaking out, we can like kind of get ahead of that and roll up the short call. Okay. And what does that do? It gives us the opportunity for the leap to appreciate in value more. So don't forget that your leap can appreciate in value. You see, there's like a lot of moving parts here, and these are complicated to manage. This isn't like super imperative to you being successful here, but if having your leaps gain in value as well as collecting premium is important, or rent on your house, you might want to consider that as a reason to roll out as well. Okay, so here's how to roll out the short call step by step, if you're a little bit confused as to how this works. The first thing is that you have to buy to close the current short call. So if we sold the 177 strike price, call expiring on March 28th, 2025, we buy it back before expiration if the stock price is still in like the 160s, like in this example. So it wouldn't cost very much to buy this back, because especially if we're close to the expiration date, because the stock is still pretty low compared to the strike price that we sold. And then we just sell a new short call with a further expiration date. It's as simple as that. I usually choose a date that's 2 to 4 weeks away in expiration date from today's date. And I pick a strike price that's still slightly out of the money, in the range of the 170 to the 177. You can play around here. Remember that the diagonal spread gives you the flexibility to move these strike prices around with greater flexibility. And that's kind of the benefit here. Like, you don't have to nail it on the strike price. You could choose a range, and yes, that gives you maybe less flexibility if the stock rips, but it doesn't really matter if the stock falls. And the thing is that nobody knows for sure if stocks are going to go up or down. Don't let anyone fool you when they say they do. This slide is all where we start to see the potential of how the diagonal spread works. Okay, so if we buy our leaps, all right, and we sell our first call against that leaps, our original short call that we're going to sell is the Google 177.50 on March, that expires in March 28th, this is supposed to say, guys, for $130 in premium. Then we make $130 in premium right off the bat. If the stock price rises to 175, it's getting very close to our 177.50 strike price. So we would get a stock alarm because we would have set that up in advance, and we would know it's time to roll. So then we would roll. So what would we do? Let's just put an example in here. I just went ahead and did this, and I was like, okay, the new short call that we're going to roll into is the 180 strike price. So we're going to give ourselves more room for that stock to go up and raise the strike price to 180. We're going to choose the expiration date of April 18th, and we're going to get a net credit here of $120. So the total premium collected so far on the initial call and then the rollout is 130 plus 120, which equals $250. So do you see the potential here? If we do this for a year, it really starts snowballing up into quite a good sum of money. So rolling lets us continuously generate premium while avoiding assignment, like having to deliver these shares to somebody else, the other trader, okay? It also lets us adjust to the market movement without losing the trade. So rollouts are just like a beautiful thing to do on the diagonal spread, and absolutely necessary as well. If the stock moves above your short call strike price, you could be forced to sell 100 shares at that strike price, which could result in a capital loss if you don't own the shares, and being forced to sell your long call because the house you were renting position entirely. Okay, so let's just get into this because it might be a little bit confusing. But anytime that you sell a call, you are telling the other person on the other side of that trade, hey, I will sell you these shares. I'll provide these shares to you if the price of these shares goes over the call that you bought, the strike price, okay? So anytime that they feel like exercising that when the stock price goes over the strike price, they can do that. So if it happens even for just a minute, you can like just go into your account and go like, oh my gosh, I've just been charged $20,000 because I had to provide 200 100 shares that were worth $200 a piece to somebody because I sold that option. Okay, so that's why you want to roll out. It's very rare that this happens just sort of like mid trade. It usually happens more like on a Friday. That's usually when assignments happen, but it can happen at any point in time. And it definitely is more likely to happen if there's a dividend to be paid. All right. So we get into that on my course. It's one of those things that you do need to be aware of. But there are a lot of ins and outs here, and it's too much to go over on videos like this, but I wanted to kind of highlight that real fast. The reason you might be forced to sell your long call or the house that you were renting position entirely is like maybe you just need the capital to fund the buying of those shares. So then now you've just lost your house and you can't collect rent anymore. That sucks. So you don't want to get yourself in that position. So that's one of the reasons you want to be able to know how to manage these positions well. Okay. So how to prevent an assignment is, number one, we're going to use rolling to extend the trade. We just went over that. We're going to avoid rolling on the last day of expiration because it could be too late. It really could be too late to do that. Don't leave it until the last minute, and don't let that like hang out, the stock price hang out above your strike price for too long. It's just one of those things where you're putting yourself at risk when you don't have to. Also, don't obsess about when the right time here is to roll. Like if you are like, oh, it's $1 less, it's $2 less. Should I roll? Should I not roll? We can't, just remember, you cannot predict the stock's movement. So just make a choice and go with it. It's not the end of the world. Like as long as you are not leaving yourself in a position to be assigned when you don't want to, you're making the right choice in my mind. That's how I see it. Like if I spent too much time thinking about these things, half the time I would be wrong. So why spend the time? Because again, I don't know which way stocks are going. They're always sort of trading in a range unless there's a big market fall off or a big pump. And nobody knows when those two things are going to happen. Even the best chartists don't know that. They're often wrong. Okay, and number two, monitor your trade with alerts. So I set an alert at $1 to $30 below the short call's strike price. To give myself time to adjust. Okay, so you guys are like, $1 to $30? What is she talking about? Okay, so if a stock is less than $100 a share and it doesn't move, it's not that volatile, I'll do $1. Okay, if a stock is like in the $30 range, I'll do 50 cents even, or $1. If it's Costco, I'm doing $30 because that stock will freaking rip $30 to $40 in a day, or $30 in a day and a half. And I want some advance warning because it's a big move that I've got to make on that one, okay? So you kind of need to be aware of how much your stock likes to move in a day, okay? So you really need to be aware of that when you pick out the stock alarm price that you're willing to set on that stock alarm. And then know when to exit the short call early. So if the stock is exploding upward and you don't want to keep rolling, you can lose the short call early and let your leap run. So when I say when you can lose it, like a lot of times there's just this situation where I'm trying to think, like a good example would be recently if anyone's been watching Palantir. So if you've been running a diagonal spread on Palantir and it went up from $40 to $120 and you bought a leap that had like a 3-year expiration on it, at some point there it might have been worth it to buy to close the short call to let that leaps just run. Just run. Because it's impossible to keep up with a stock that's running like that on a rollout. I mean, it's not impossible, but it's really hard. It might be impossible. If you've had an experience with running diagonals, you'll know when impossible hits you. And sometimes it is impossible. So you need to be aware of that. These are not completely foolproof. There is the risk that you may not be able to roll out and up, which you'll have to see where that lands you. All right, so avoiding assignment and protecting positions. Managing assignment risk isn't about avoiding it entirely. It's about having a strategy in place to protect your trade while maximizing profits, okay? So you guys need to be aware of the fact that, like what I just said, there are times when you cannot roll out. Like rolling out is a strategy. it gets you so far. It doesn't protect you from everything. Every once in a while, you may have to be assigned and provide these shares because your stock just might be ripping to the point and the market might be ripping to a point that you can no longer roll. You run out of time on your leaps, or there's no good option to roll into on the options chain. You'll know it when that happens because you'll be looking around and you're going like, there's nothing I can do here. And when there's nothing you can do there, then you do actually have to provide the shares. So diagonal spreads, they provide us the ability of not having to put as much capital in the market in the beginning, but that doesn't mean that we're guaranteed that until the very end. So just be aware of that. You could also, at this point in time, if you get in that position, you can close the whole trade out. It's going to be really interesting to see then if you're at a net gain or loss. My guess is you're going to probably be at a gain, but it depends how long you've owned your house and what you paid for your house and how much rent you've collected. So it's a bit of a complicated, there's no real way I can answer that question. You just have to do this trade, get good at it, and don't trade it on really volatile stocks, because when you trade it on really volatile stocks, that is when the situation comes into play the most often. And it's not a fun situation. You just sort of feel stuck. It's not going to lose you a ton of money. You're just going to feel really stuck. Okay, so how to adjust if the stock crashes. Many traders panic if the stock price drops below their long calls strike price. Okay, so a lot of people freak out here and then they think, oh, maybe I'll just close this at a loss. And I'm like, why would you do that? That doesn't make any sense. You still own the house. Okay, so like your house dropped in value. I mean, I remember the financial crisis when everyone's house's value dropped in 2008, 2009. Now, those of us who could afford to keep our houses and pay the mortgages, or our houses were fully paid for, we didn't sell our houses, did we? No, if you owned your house, you kept your house. So I would say I would keep my house right here and keep collecting rent. The rent that I'm collecting might be less, but I'm still collecting rent, right? So it doesn't matter if the leaps is in or out of the money. It's irrelevant. What's important here is, can the leaps still collect rent? That's the only thing that's important to me in this trade. Okay, so how to adjust if the stock price declines? So you're like thinking, I don't know, I kind of want to close this out for a loss. And I'm here to tell you, hey, there's a different way. So on this spread adjustment, I'm calling this calendar spread here because you can use the calendar to really work to your benefit and how much time you still have left. Okay, so you're going to keep that long-term leap open because it still has time value. It's still an asset you own for a period of time. Like if you owned a 3-year leaps and you're only a year and a half into it, you still have a year and a half left to collect rent. Who cares if it lost value? No big deal. Now you just sell a new short call or roll down to a strike price that's closer to the stock's price. So if the stock was 145 and now it's 135, all you do is sell a 140 strike to generate more income. And you just keep rolling and rolling and rolling until the stock recovers, okay? The other thing here is it doesn't even matter if the stock doesn't recover. You can just keep rolling and rolling down. Okay. The only thing that's going to stop you from rolling down is if the collateral gets too much in your account and you no longer have collateral. That's really the only thing that's going to stop you here. So again, I can't really drive home this enough. Diagonal spreads are forgiving and you can recover from short-term drawdowns or even long-term drawdowns as long as you keep generating income from rolling the short calls or waiting till expiration on the short call and then selling a new one on a Monday. Okay. All right, the next topic we're going to go into is using market trends to maximize profits. So by adjusting to the market, you can get a maximum amount of money from the diagonal spread. If the market is strongly bullish, sideways, or bearish, the diagonal spread works in all of these markets if you choose the purchase price of your leaps accordingly. Bearish markets work better with inexpensive leaps and bullish markets work best with expensive leaps. And that's really the definition here. That seems complicated, but it's not. It's so simple. If we are going into a time that looks uncertain, I wouldn't buy expensive leaps to run these on. If we are looking at a time that's bullish or bearish, I don't really care. If I'm buying inexpensive leaps, they work in both. So use that information to your benefit there, okay? Diagonal spreads give you the tools to stay profitable no matter what happens. It's a highly flexible trade, and that's why it's my favorite. Okay, so I just told you there's no reason to sell your house, except for sometimes there is a reason to sell your house. Okay, so there is a reason to exit this trade. There are a few reasons. So we're gonna kind of get into why you would do that, when's a good time, et cetera, et cetera. So we're gonna get into when to sell the leap for a big win, what to do if the trade moves against you, rolling versus closing the trade, and how to exit the trade for maximum gains. Okay, so when to sell the leap for a big win. While the short-term call is kind of the thing that we want to do to get rent, right, and bring in a consistent income, the leap that you buy at the beginning can be a wealth builder as well. There may be the goal to capture as much upside as possible while making a capital investment on that leap as well. I mean, like if that works out that way, because the stock rises, you're going to be so thrilled because you're going to have collected short-term rent or maybe even long-term rent, depending on how long you are holding this leaps. If the stock continues to rise, the leap rises, and you're making money on two sides of the coin. You're just going to love this, okay? But there will be a time, potentially, if you are in the situation when the stock is rising, that it may become time to sell the leap, okay? So the first time or instance when I would consider selling the leap is the leap has more than doubled in value, or it's gotten to about a 50% gain. There I usually like to sell the leap. And why? Why do I like to sell the leap? Just because, I mean, when the gains are there, they're not there forever sometimes, like, right? I mean, I think we've all been there where we've seen a trade go up and it's there for 2 days and we just think, oh my gosh, like I love my account value right now. This is really nice. And then we wait a week and then that gain just disappeared because something in the market changed or something in the stock changed. So I don't like to see those things disappear. One of my mentors said to me, a gain is a gain. Take the gain. Take the money on the table. When you see it, take it. So anytime those leaps go up more than 50% in value, I like to sell them. That does mean that I have to close the call I sold against it for not a loss, but I don't get the full capital from the call that I sold, but that ends up being worth it to me. Number 2, the stock has made a huge move upward. Sell or you'll get reverse FOMO. So that was the thing that I was just talking about. Like if the stock makes a huge move upward, right? Just massive, like the Palantir example I was talking about earlier. Those kind of moves don't always last very long. The only recent move I can think of that's went up and just stayed up like that was Nvidia. And you have to go back a long time in history to find another stock that was like an Nvidia, okay? So if that stock dumps afterwards, you're going to get reverse FOMO. You're going to, like, a lot of people get FOMO on the way the stock goes up and they're like, I wish I had bought that stock at $20 because now it's $120 and that was only 2 months ago. Well, if your leaps was worth $3,000 and then it sinks down a month and a half later to $1,500, you're going to get reverse FOMO. Okay, so don't let that happen to you. Don't be afraid to sell your leaps for a win. If the stock goes down later, you could just go back in and buy a leaps for cheap again. Like there's no time constraint on when you can buy these things and when you can sell them. You've got the rest of your life to be a trader. Okay, if the stock jumps in 20 to 30% in a short time, selling a leap can lock in gains before the pullback. So, I mean, again, like stocks just don't stay the same. They rocket off and then they pull back. So when they rocket off, I just take advantage of the fact that they've rocketed off. I'm not waiting for them to just fuel that much faster. That's kind of like not the norm. And so I go with what normally happens instead of what rarely happens. Number 3, the short call is limiting further gains. Okay, so if rolling the short call higher no longer brings enough premium to be worthwhile, it may be just time to exit the whole trade. So for example, like if I have a leaps and it's got like 3 months left on it and I'm only bringing in $10 per roll, it might be like I've outgrown the situation where I want to keep rolling this because maybe my account has grown and now I'm just trading leaps, doing rollouts that are paying me $80 or $300 per 3 weeks, and the $10 thing just no longer seems worth it. Just pat yourself on the back then that's where you are and you can just move on, okay? So here's an example of when to sell a leap for a big win. So this example trade exit, if I bought Google 185 leap for $2,500, and now it's worth plus $800, so $2,500 plus another $800 due to a stock increase. I don't question myself on, should I sell a leap? No, I sell the leap. Like, Take the money on the table, because if there's a pullback, that's gone. And a lot of times we don't know how long pullbacks last. And any money that you can pocket is better than money that just disappears before your eyes. A great trade is only great as if you take the profits. So knowing when to take profits and exit prevents unnecessary risk of keeping your money in the market, right? Like keeping your money in the market, it is at risk. You have to remember that. So anytime you can take money out of it and lock in a profit is better than not. So again, a profit is a profit. Don't be afraid to take profits. What to do if the trade goes against you? So many traders panic if their leap loses value, but there are ways to recover losses instead of taking a full hit. Okay, so here are 3 ways to recover from a losing trade. All right, so number 1, keep rolling. So if the stock drops and the market's dropping, start selling closer out of the money calls for better premium collection. This keeps the trade alive and lets you generate income while waiting for a recovery. So this is like a recap right now, okay? This is the recap. So there's like multiple ways this trade can kind of move against you. One of them is that their stock rockets off real fast and it's hard to keep track of it going up, and then you're just gonna keep rolling. And if the stock goes down, you're just gonna keep rolling. Rolling is like literally the name of the game. Number 2, sell the leap or roll it, okay? So if you've never thought of rolling your leaps calls, you can and should check it out. The long leg has a lot of flexibility, just like the short leg. It's too much to get into here. This is one of the reasons I do teach a course, but I just want to reiterate that the only bad trade is the one that you don't manage. A losing diagonal spread can generate profits if it's adjusted correctly. So these trades just have so much flexibility, and you really just need to spend some time on the options chain looking at how to adjust the lower or upper leg to see what can be done. If you're holding a winning leaps here, and I'm going to call that a winning trade, and you want to know another time that you should think about exiting, if the leaps is up big and you're right before an earnings call, might be a great idea to sell it because you don't know what's coming in that earnings call, do you? And if there is a negative announcement, it could really send that leaps down. And so wouldn't it be great to take profits off the table and take that risk off the table? I think so. So that's when I like to sell mine. Okay. Another one is when the stock hits major resistance levels. So if you know that your stock is trading in a range between 220 and 240, I can remember Apple trading in that sort of range recently. And, it's coming up to the end of your contract of your leaps, and Apple hit 240, but you got 3 months left. But sometimes it makes it dips down for a month and a half to 220, and then it takes a while to come back up. Wouldn't you want to sell at the 240 3 months before expiration? Because you don't have much theta left, and the stock is at a high. Seems like a good time to sell. That's probably what I would do there as well. So knowing when to exit is just as important as knowing when to enter. And the best traders are those who lock in gains at the right time and think about these things in advance. All right. So if you want to learn my entire options trading strategy and the 7 trades I used to make $400K last year from a $600K portfolio, then watch the video that I linked down below in the description. There's also a link there to book a call with me to get more of the fine-tuned details because there are many. There are so many, but I promise to also keep it simple. So if you want help with implementing this trade or any other trades that you would like to do in an options portfolio, book a meeting on the link below and we will get you into the mentorship program.